Hello and welcome to a brand new episode of Smart Money. On Smart Money today, we talk about investing into debt funds, a basic masterclass on why you should invest in debt funds, the myths around investing in debt funds, and how to go about it if you are a beginner. Our expert today on the show is Nasser Salim, the managing partner at Flexi Capital. Nasser, thanks a lot for joining us on the show. Before talking about how to invest in debt funds, right, let's just try and bust some of the myths, because there are so many myths about debt funds, that they're safe, that my capital gets protected, etc., etc. But just I want to understand from you, what are the biggest myths about investing in debt funds?
Good afternoon, Sonia, and thank you for inviting us on this show. I think, clearly, you rightly said, there are enough myths about many investing asset classes, but I think debt today plays a very, very important role in all our portfolios. And therefore, it's very important to know. We've often heard that it's like risk-free return, it's secure, and the principal is not at risk at all. Debt as an asset class is safer than equity. We've also heard a lot of investors saying that many a times. And also, I think most importantly, they say returns are assured, which I must tell you is not the case at all. And I've also, we've also heard people talking about the fact that your capital is guaranteed. So, Sonia, here's the clarity. I think, these are myths which need to be clearly debunked, if I can say so. Debt as an asset class is binary. The risk is binary, right? If you get your money or you don't get your money, unlike equity as an asset class. And therefore, it's very important for investors to know that there are inherent risks in debt, just like the way there are risks in FDs, for example, also, right? But debt as an asset class comprises of multiple factors that you need to look at before investing, which is why we also have SEBI, which repeatedly comes out and says they've launched riskometers in debt funds. We've also had many disclaimers being put out saying that, past performances should not lead to, future guarantee returns and so on and so forth. So I think, Sonia, it's very important to understand that, and we will kind of try to address some of those as we go along.
Absolutely. And I want to take it one by one, right? I mean, let's try and bust the first myth. You said that it's a myth that debt funds give risk-free returns. So what are the key risks that are involved if I invest in a debt fund? Because the common perception is that at least my capital will be protected if I'm in a debt fund, right? You tell us, what are the risks?
So, Sonia, again, there are three inherent risks in a debt fund, right? And this could be at a debt EIF, PMS, mutual fund, whichever fund you invest in. And the key risks are, interest rate risk, then there is something called a credit risk, and there's a liquidity risk. Now, let's probably explain each of these in a minute. Interest rate risk is something which is the biggest danger, because that is basically a function of interest rates. And that's why it's called interest rate risk. Interest rate yields and your the bond prices are inversely related. So, for example, Sonia, in the last few, since March of 2020, when COVID happened, we saw all central bankers push down interest rates. So, we had the RBI come in and they came in and said, we will reduce repo rates because we want to ensure that lending costs come down. Now, in a debt fund, basically you're investing, you're putting money. When you're investing in a debt fund, basically you're giving out money to a fund, which is basically giving out that money to various companies or a group of companies through these debt funds. What we have to understand is when interest rates come down, Sonia, the bond prices start to shoot up, because you would obviously want to end up getting a higher return. It's a very simple philosophy. What it says is, if I'm getting today, a bond is fetching me a 5% yield. Tomorrow, if the yields come down, if the RBI reduces the interest rates, it comes down to say sub 3% to 2.5%, 4%. The people who are holding a 5% bond paper obviously start charging a premium, and therefore the bond prices shoot up. And then that's exactly what happens vice versa, which is in today's scenario, Sonia, we're now looking at an interest rate increase all over globally, including India. I mean, RBI is also increasing interest rates gradually, as we know. And therefore, an inverse relationship plays out beautifully in this case. So if you're investing in a debt fund where you're betting on a longer tenure and interest rates start to move otherwise, you will start losing money, and your bond price will start to fall. So any investing today will have volatility to the extent of losing principal on account of interest rate changes, what it was since March of 2020 to now, because we've seen a scenario where interest rates were coming down, and now they're going to go back and they started to go up. So therefore, you will lose principal.
Okay.
That's the first one. The second quick one is something called credit risk, Sonia, which is basically it's on account of a deteriorating financial credit worthiness of the companies that a mutual fund or an AIF or a PMS debt fund manager is investing in. Now, obviously, we've seen scenarios in the past, Sonia, where we've seen credit worthiness decreasing, financial stress coming in balance sheets, and obviously investors feel that, they get to know at a very later stage, and therefore there is something called credit rating, which we'll explain to you in the next few minutes, which talks about how to evaluate the underlying bonds exposure in a particular fund. And that's the second risk, which is basically if the financial credit worthiness of a company falls, they cannot pay you back the money. So therefore, there is a credit risk at play at a debt investing fund level. The third one is the liquidity risk, where basically what it basically means is that the fund manager can't meet redemption requirements, Sonia. If a bond is defaulted, which is basically if the company is not credit worthy enough to pay its commitments, because debt, I must tell you, Sonia, is a promise to pay. You're investing, and it's basically a promise that we will pay you a certain coupon or a certain rate of interest, depending on what frequency you use in terms of agreements. So it could be semi-quarterly, annually, monthly, and therefore, if at the time of commitment liquidity risk is not met, that's a big risk in itself, and therefore that can impact your underlying returns, and your goal for which you may have invested may get completely haywire.
Okay, so there are a lot of risks, right? Interest rate risk, credit risk, liquidity risk, and as we've seen in the past as well, these are situations that don't only impact one fund, it impacts the entire industry, right? How can we mitigate these risks, Nasser?
So Sonia, again, as you said rightly, it's impacted industries, and we've seen these scenarios in 2020 as well. We've identified a few key metrics, Sonia, in keeping it very simple and lucid. What we've done is we've identified a few metrics basically for our viewers to understand. If you can just track those metrics and you ask those relevant questions. So the first one, I think something is what we track in all debt funds, and I think viewers must, investors must ask this question is, what is this yield to maturity? I mean, this is all over available. It's simply available at all, prospectus. You can have a chat with your advisor and distributor on this. There's something called yield. And it basically says, and what we track for ourselves is alpha generation on that yield. Now, it basically measures the number of times the fund has outperformed its stated net yield to maturity over a 3-year period, for example. I mean, in this case, I'm telling you a 3-year period. And funds with a higher probability of outperforming its yield, which is the coupon that you're getting, are ranked usually better, right? Now, what we have to understand is that this yield concept is nothing but a special measure, Sonia, of the total return expected on a bond each year, and a bond's internal rate of return, basically, it's measured through something called the internal rate of return. And this bond each year, if the bond is held until maturity. So basically what we're saying is it's a measure of the total return expected on a bond each year if the bond is held until maturity. As simple as that.
Okay.
And it's expressed in an annual rate, or it is denominated by something called internal rate of return, IRRs, which is essentially a bond's internal rate of return if held to maturity. Now, it's also called the book yield or the redemption yield, because that's the yield at which you will receive your money. The promise that I just spoke about, Sonia. And it obviously differs from something called nominal yield, which is usually calculated on a per year basis. This is the yield to maturity is at maturity, and nominal is basis on every year yield. So that's one of the few things that we must fundamentally track when we speak and look at debt funds. Okay. The other one is, again, we just spoke about that, Sonia, is something called credit rating. And this is a very, very interesting perspective because, we've seen and we've put a small case study for us, of our viewers as well, to kind of explain the logic behind this. Basically, all bonds have a credit rating. They not all, but they should have a credit rating, ideally. And it's nothing but a rating is nothing but a score that is used to judge the quality and the credit worthiness of a bond, which I just spoke to you about. Now, simply put, the higher the credit rating of the holdings, usually lower are the yield to maturity. So it's very simple. If you have a higher a higher credit rating, the yield is normally lower. If you have a lower credit rating, because a lower credit rating means basically you're investing in bonds, Sonia, which are susceptible to higher default risk, if I can say so.
Sure.
Or which may have possibly a lesser credit worthiness as compared to something like a higher credit rating. So a higher credit rating could range from, could, for example, starts at AAA. And the lowest could be BBB minus, for example, Sonia. So obviously the logic is very, very simple. The ratings are published by credit rating agencies regularly, and these are used by investment professionals like us to assess the likelihood of the debt which will be repaid. So again, a very, very strong barometer of metric that we need to use for debt funds.
Oh, absolutely, absolutely. Credit rating, looking at credit ratings is the most important, I guess. Any more metrics that we can use to track and mitigate risk?
Yeah, so the other quick one is something called modified duration, Sonia. And modified duration basically measures the change in the value of a bond in response to a change in 100 basis, which is 1% change in interest rates. So basically, in a nutshell, what it tells us is it's called modified duration. And as a bond's maturity increases, duration increases, and as a bond's coupon and interest rates increases, its duration decreases. So, for example, if one has to invest in a particular fund where you have a horizon of, say, investing for 3 years, you should ideally invest in a fund which has a lower modified duration. Because a fund with a higher modified duration, Sonia, will have a higher volatility, and so in a rising rate, which is currently in a rising rate environment, if an investor purchases a fund with a high modified duration, he would have to face higher mark-to-market losses as compared to a shorter duration fund. So that's the relevance of modified duration, which is again a very, very important factor.
Okay, this is very helpful. Let's do one thing, Nasser. Let's take a bit of a commercial break, but don't go anywhere. We'll come back in just minutes from now to continue our discussion on investing in debt funds, all the pros and cons, debunking a lot of the myths, etc. All of that lined up in just a bit. Stay tuned.